Okay, so today we're going to be looking at financial instruments in the form of our workshop. I have done something slightly different for you today. I have made a nice little financial instruments workshop diagram, which hopefully you will find useful as we go through tackling the questions. Now, I know from Accounting 211 that you are already familiar with your financial instruments. So this is really just to build on a little bit what you've done already. We're really re-emphasizing the topics here. There's nothing too new in 212. But it really is just to reinforce those concepts and to make sure that we have a good grounding as we go through to third year. So for our financial instruments workshop, let me get to my next slide. And we look at what is a financial instrument, and we look at our basic broad categories of a financial asset and a financial liability. Now, what is important is you've probably already gone through your lecture videos. Remember, we have a real added value and advantage for being online. You should be able to go through your pre-recorded lecture videos. That is what you would actually be getting in a face-to-face environment. And we have this added bonus of being able to do this workshop as well, which typically we wouldn't have time for in a face-to-face environment. So we really must take advantage of all of these additional resources that we're able to provide to you when utilizing our online environments, especially since we are going back face-to-face for 2023. So you should already have a basic idea of what a financial instrument is. Our two broad categories being a financial asset and a financial liability. We also will be looking at the broad categories of either a debt or an equity instrument. And it's important that we understand that our debt and equity instruments could be either financial assets or financial liabilities, depending on not only the classification of those, but whose point of view we are looking at. And we'll be going through this in great detail. Thank you, Arthur. Yes, please don't forget about your SI sessions on Fridays as well. So a lot of added value we are able to provide to you when utilizing our online environment. Do make use of these resources. So one of our first steps you'll see that we come across, because I have made steps for you when tackling your financial instrument question, is we need to decide, do we have a debt or an equity instrument? When we are looking at our debt or equity instruments, how are we going to classify these? So you'll find that there'll be a financial asset for one entity. Remember, we're going to be looking at a transaction, and this transaction takes place between two parties. So you always need to be very cognizant of the fact that we need to know whose point of view are we looking at, whose books are we looking at? Because in one party's books, we are going to have a financial asset, and then in the other party's books, we're going to have either an equity instrument or a debt instrument that is going to take place. Okay, and we'll see this coming through, and I will be bringing us back to this information as we go through our examples as well. So financial asset, very broadly, that's often going to be possibly that somebody owes that company, so they've paid money up front, similar to a debtor. I like to go back to the thought process of a debtor and a creditor, because that really is essentially the basic brought down of financial instruments. So a financial asset, an example of a financial asset that you've already dealt with is a debtor, a trade receivable. So that means you've given them inventory, okay, and they're going to pay you back in the future. So they are a form of financial asset. They're an asset, a current asset in our statement of financial position. And that is going to be one of the items that you might find arising within this type of a transaction. When we look at our debt and equity instruments, equity instruments, for all intents and purposes at second year, is going to be your share capital. So when we think of equity, we want to think of our equity section of the statement of financial position. What kind of items do we see there? And very often we're going to be brought back to share capital. And if we look at our actual definition, you'll see that it's any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. And when we look at our statement of financial position, that is exactly what we see. That is what equity is. When we look back at our accounting equation, assets equals equity plus liabilities. So equity, if we make that the subject of our equation, it is the residual interest in the assets after deducting our liabilities. When we look at our debt instruments, what type of items do we expect to see coming through? You'll often find in your examples things such as debentures that really I like to refer to as an IOU note. It's like a loan. You'll also see things such as bonds coming through. So when you start to see that type of terminology, you know we're going to be dealing with a debt instrument. And it is defined as being an obligation that enables the issuing party to raise funds by promising to repay a lender in accordance with terms of the contract. So that's the type of thing we expect to see with any form of bond or debenture or loan. That is the essence of it. There's going to be some sort of promise to repay them, and in terms of a contract. So are we going to pay equal installments every year for 3 years? Are we going to pay interest of 10%? So how is that mechanics going to work? And so it's really just formalizing a lot of the terms and a lot of the financial assets and financial liabilities that we've actually already come across as we have proceeded to Accounting 212. So once we've done our broad classification of, do we have a debt instrument? So do we have a loan, a debenture, a bond, or do we have an equity instrument such as share capital? We then need to decide, well, do we have a financial asset or a financial liability? And remember, we said the absolute important part of this is going to be whose point of view are we looking at? Now, why do I say that? Well, think about a loan. A loan in somebody's book, if they're the person who has actually given out the loan, they're going to have an asset because they're going to receive money back in the future. But the person who's taken out the loan, they owe money. They're going to pay back money in the future. So it would be a liability in their books. And that's why I say it's really, really absolutely vital that we are always looking and making sure that we know whose point of view or whose books are we looking at in the question, because that's going to determine whether we have an asset or a liability. So I just want to do a little drawing with you quickly so we can illustrate it. It's always nice to actually see things. So say you have a scenario where you have a transaction, A lends 10,000 Rand to B. So say you have that type of a scenario. Now, what I want you to think about is what's going to be this 10,000 Rand in the books of A. So in the books of A, they have lent 10,000 Rand to B. So what does that mean? It means that in future, they are going to receive money. They've given money now, and they're going to receive money back in future. So from the books of A, from their point of view, they will see this transaction as being an asset. And when we look at B's books, let's have a look. We look at the books of B, they are receiving money now, and they're going to have to pay it back in the future. So in the books of B, for this exact same transaction, they're going to see it as being a liability. So as you can see, it's very important. Then we look at the required of our question and say, well, are they asking us to look at the transaction from the books of B, from B's point of view, or from A Limited's point of view. And that will, as you can see, completely change our answer as to whether we have an asset or a liability. That's why it's so important with financial instruments in particular that you are very, very careful with the transaction and you know whose point of view you are looking at it from. And so just something to keep in mind. I know it might seem very basic at this point, but this information is going to be vital for you getting your answers correct as we move through in our questions. And I can tell you how often do I get questions where students are confused as to whether there's an asset or a liability because they're just not focusing on which company they are being required in the question. Okay, so just something to be mindful of. Let's go back to our slides. So a lot of this you have already covered. You've seen it in Accounting 211, and you've recapped it hopefully in your full lectures for 212. But just as a brief overview, very often your financial asset will be some form of cash. It can also be an equity instrument of another entity. In other words, it could be share capital of another entity. So perhaps you've invested in another company. It also could be a contractual right to receive cash or another financial asset from another entity. So think about your trade receivables, your debtors. You have the right to receive cash from them in the future. Exchange for financial asset or financial liabilities under conditions that are potentially favorable, where you'll see that the contra is true for financial liability, where that exchange could be under unfavorable terms, or the contract is settled in the entity's own equity instruments. Okay, so the last two, where we look at the exchange being favorable or unfavorable, as well as settlement in shares, is not something that we focus on in second year. You will go through that in more detail for third year, but we do include it here for completion of your definition, so you are aware that that would be something that you'll be looking forward to as you go through to third year. But we really focus on the very first few bullet points where we look at the contractual deliverance of possibly cash or an obligation to deliver cash or a financial asset to another entity. So really a basic introduction of financial instruments, not going into too much detail at this stage. Then looking at our measurement of a financial asset in particular. So as you can see, what we first started off with is we want to ascertain, do we have a debt instrument or do we have an equity instrument? After we've been able to determine that, we then want to move forward and say, well, do we have a financial asset or a financial liability? After we've done that, we then need to further move forward into whether that financial asset or financial liability, how we're actually going to go about performing the measurement thereof. So for a financial asset, there's basically, there are technically three categories. However, I like to say there's 4 categories. You do have amortized cost as your first category. Your second category is fair value through OCI. Now, you can have fair value through OCI for debt instruments and fair value through OCI for equity instruments. So I do like to separate those because there is a slight difference as we go through our measurement of OCI for debt or equity instruments. And then our last method is fair value through profit or loss. Now, financial assets, as you can see, having basically 4, in essence, categories, there is quite a lot to consider. We need to know, how do we know which of these categories we are going to actually fall under? So because you've done that initial classification of whether you have a debt or an equity instrument, what we've then done for you is actually split this financial asset into what will you do if you have a financial asset that's a debt instrument, and what will you do if you have a financial asset that is an equity instrument. Okay, so for your debt instruments, what are we going to look at? So we look at our contractual cash flows, which ultimately refers to the cash flows being paid on specific dates. That really means that this debt instrument, which remember is a form of loan, those cash flows perhaps are going to be, say, 10,000 Rand every year for 3 years. And that payment is going to reflect a payment of the principal sum. So say the loan was for 20,000 Rand, as well as the interest, which is that interest portion on the principal sum. So those are the kind of things that we're looking for when we are trying to determine this debt instrument. What type of item do we have? What are the characteristics that revolve around those? And then we're really going to be focusing on the intention of the entity. So that's referred to as the business model of the entity. And this is really where it's going to drive you to use one of those 4 broad categories for measurement of financial assets. So we're going to look very carefully in the question. Quite often they do tell us what they have decided to classify the financial asset at. But if they're silent, this is what we're going to be using to be able to determine how we are going to measure this financial asset. So is the intention of the business to collect the contractual cash flows? That means they want to collect the interest and they want to collect the principal sum of that loan that they have obviously lent to someone, since we are looking at it from a financial asset point of view. If that is the intention, simply to collect the contractual cash flows, then we are going to use the amortized cost model. And you'll see that amortized cost table coming through, which you're already familiar with from first semester. The second look at terms of the intention is that if they want to both collect the contractual cash flows and to sell those assets. So ultimately, they want to get rid of that debt instrument. Perhaps they want to sell that debt onto somebody else for collection. So this is going to have a intention of both collecting and selling the assets. And then we're going to use fair value through OCR debt. And you're going to see that when we have fair value through OCR debt, we actually use that amortized cost method, and we just take it one step further, whereby we fair value it at year end. Or is their intention simply to sell these financial assets? So they don't want to keep them. They don't want to continue keeping it until the 3 years of the loan is up. They just want to get rid of it, sell on to somebody else. Then we will use fair value through profit or loss. Okay, so it's a lot to think about. As you can see with financial instruments, there really is a lot to consider before you even get to the point of providing your journal entries and even doing your workings in this case. So you do need to be mindful in your question and really keep going through all of these steps in your mind as you go through the question. Because if you skip a step or you just try to go straight into journal entries or workings, you might not have done the correct classification. And as you can see, having so many different measurement methods can make things incredibly complicated and send you down the completely incorrect path. So you really do want to focus on getting these steps correct, making sure you're getting through into the correct measurement model, and then you can go through workings and continue in that way. So when looking at a financial asset as an equity instrument, this is nice. It's a little bit easier. So this means you've got perhaps an investment in shares in another entity. And really here you have 2 options that you would look at. So amortized cost is out of the water. We're not looking at that. If we have our equity instruments in terms of a financial asset, so you'll either be using fair value through OCR equity or fair value through profit or loss. So there's no amortized cost option if you have equity instrument that is classified as financial assets. When we are looking at classifying as fair value through OCR equity, what's quite nice is really they need to tell you in the question, because the entity has to designate the shares, the financial asset, as fair value through OCR on initial recognition. So they have to tell you that the company has decided that they're going to use fair value through OCR, and that decision is irrevocable. And that really means in basic terms that they can't change this decision. So once they've decided that they've got a financial asset, it's shares, it's equity instruments, and they're going to use fair value through OCR equity as their measurement model, that is done and dusted. They cannot decide to change it later on to perhaps use profit or loss. They can't do that. So it's an irrevocable decision. They need to make it up front, and you have to be told it, which is, like I said, really nice, because that makes our job a lot easier when we are trying to assess these questions and we're trying to figure out what measurement model we should use. Well, the question then has to tell you fair value through OCR equity, and that makes things a lot easier. They might ask you perhaps, is there an opinion of you as the accountant providing advice to this client? Can they classify this financial asset that is shares as fair value through OCR? And then you need to be able to advise them and say, well, an investment in equity instruments that is not held for trading and not a contingent consideration within a business combination, then yes, they can use fair value through OCR equity as a measurement model. So not held for trading means it's not going to be something that's going to be held for trading, not included then on the JSE for trading, that type of thing. So there's no intention for sale of these particular shares. And then in terms of the contingent consideration and IFRS 3 business combination, nothing to worry about too much at second year level, but you will cover that in third year as you do goodwill and business combinations. You will touch a little bit on business combinations with Vanessa as you start working through groups in about 2 or 3 weeks' time. But really, we are looking at going to be the sale of those shares. That's really going to be vital for us at a second year level when we are trying to assess should fair value through OCR equity be used as a classification model. Remember, the types of questions that you can get will also include things that where we expect you to perhaps be critical. So maybe they said that these shares are held for trading and they want to use fair value through OCR equity to measure their financial assets. Can they do that? And then you should be able to identify and say, well, no, you can't, because they must not be held for trading. They can't be held for sale for you to be using that classification and measurement model. And so always keep that in mind. Type of critical questions you can also be asked. So it's really important that you know your work forwards and backwards so that you get any type of question, you're able to analyze it, you're able to critically evaluate and use your problem-solving skills. When looking at a financial liability, this also very nice and easy. We only have 2 methods here that we need to be concerned about when it comes to measurement, and that is amortized cost or fair value through profit or loss. So again, when we're looking at these 2 measurement models, there are a couple of criteria we want to be cognizant of. So generally, we want to use for financial liabilities amortized cost as our default, but it is used unless it meets the following criteria. So it's held for trading. So if there's trading, we expect there's going to be a fair value. That means it's on the JSE. There's going to be listed share prices on a daily basis. So it's held for trading. Therefore, fair value through profit or loss is seen to be a more reliable measurement model, because remember, what type of information do we want to provide in our financial statements? Always must be relevant, reliable, and have some form of faithful representation. So if it's held for trading and we're able to get a fair value, then we use fair value through profit or loss. And again, you'll see a lot of these other 1, 2, 3 bullet points, they're really focusing on the fact that the intention or the purpose is for the purpose of trading. So it's available for sale, it's for the purpose of trading, it's for the intention of short-term profit making. So all these 4 bullet points are really leaning towards the fact that the intention is ultimately to make a short-term profit. It's to quickly sell this financial liability. Okay, so those are the types of things that we want to consider when we get to a financial liability, and we need to choose one of our two measurement models, being either amortized cost or fair value through profit or loss. And what is also important is our transaction costs. So once we've then got our measurement model, one of the costs you're going to see coming through in your questions is going to be transaction costs. And it's always a case of, well, what are we going to do with these transaction costs? So for all our methods, except fair value through profit and loss, you're going to capitalize your transaction costs. What do we do with fair value through profit or loss then if we don't capitalize? Well, fair value through profit or loss, we are going to be expensing those transaction costs. Now, very often when I ask students in class, I say to them, well, if we're capitalizing transaction costs, what are we going to do for our financial asset when we bring it into our books? Everyone says, well, we're going to use the fair value and we're going to add the transaction costs, which is correct. And then I ask my students, well, what are we going to do for financial liability in terms of the transaction costs? And we're using perhaps amortized costs. We need to capitalize them. How are we going to capitalize them to a financial liability? And then my students say to me, well, we're going to use fair value plus transaction costs. And that's where we fall down. Okay, so we need to know the financial liabilities. If we're capitalizing transaction costs, we are taking fair value minus the transaction costs. And this can be very confusing because when students see capitalization, they think, well, I'm adding it to the cost of something. Now, why with financial liability am I minusing it? So let's have a look. Okay, let me erase this. Let me clear it. Okay, so when we get to capitalizing transaction costs, well, let's just type here transaction costs, and then we'll look at both the journal entries for expensing as well as for capitalizing under financial asset and a financial liability. So for our transaction costs, if we're going to expense them, what do you think is going to be my journal entry? Let's use our chat box. I really want to have a chat with you guys today. I want to interact with you. So what do you think we're going to debit if we are expensing our transaction costs? What are we going to debit? Debit transaction costs. I'm getting some. And credit bank. Oh, some of you guys are way ahead of it. That's brilliant. Good stuff. I'm getting some private messages. That's fine. So we debit our transaction costs. And what are we going to credit? I see some of you have gone ahead of that and given me the credit already. What would we credit? Bank. It's our favorite one. I'm getting some private messages. Bank. Brilliant. Thank you, Arti, for reminding us to put in our elements. Of course, with any journal entries, it is not simply enough to give us debits and accounts, credit and accounts. A journal entry really encompasses a number of different elements. It encompasses the date, debit and the account, credit and the account. We also want to include the element. So are we looking at profit or loss? Are we looking at statement of financial position? You could put here expense. That would also be acceptable. Okay. I don't really want you to put here SOCR. Why? Why do you think I don't want you to put SOCR here? SOCR has two sections. Remember, it has OCR section and it has the P&L section. Now, especially in financial instruments, you've already seen our measurement models. And we have seen we have fair value through OCR and we have fair value through profit or loss. So if we see a scenario where you tell me SOCR, I don't know if you're referring to profit or loss or OCR, which as you can see, there are two different measurement models under financial assets and financial liabilities. So it is important that we include that. And then finally, our last element would be our narration to finish off our journal entry. And remember, if our question is simply asks you for journal entries, that means you need to encompass everything, because a journal entry is a date, accounts with the elements and the narration. That is a journal entry. The only time you should leave out anything is if it tells you ignore narrations or ignore elements or ignore dates. It's the only time we should be leaving out anything. Otherwise, we should always include everything that encompasses a journal entry. Okay, so this was the nice, easy one. This was looking at expensing. Okay, so nice and easy. That's the easy one. So when we move forward, and how we're going to capitalize. Okay. So if we capitalize our transaction costs, what do you think we're going to debit? What do you think we're going to debit this time? Okay, it could be our financial asset. Very good. I'm getting some DMs. Debit financial asset. Financial instrument. I like that answer even better. So you're going to debit either your financial asset or your financial liability, depending on your classification. And we're going to credit bank, as we have done so previously. Okay, now, very interesting. If we are capitalizing, as we've done so in this journal entry, so financial asset, we have a financial asset, which we know increases on the debit side, and here we are debiting it with the transaction costs. So that means what's going to happen with the transaction costs? We must add it. With a financial liability, what's going to happen if we're debiting a financial liability? Are we going to add or subtract? Very good. Very, very good. So we are going to be subtracting the transaction costs, and that is capitalizing it to a liability. Okay. So hopefully that clears that up. Really find it important that we go through that. Might seem basic, but it just helps us to wrap our heads around the fact that for financial asset, if we're capitalizing our transaction costs, we are adding it to the fair value. And for financial liability, if we're capitalizing transaction costs, we are deducting it from the fair value. And that is capitalizing it, as you can see from my journal entries. So I hope that has helped clear that up a bit and just really provide some sort of clarity with the understanding on that. Very good, everyone. Oh, I lost my whole screen. Let's get back. Okay, so it looks like we are all on the same page and we are getting the hang of this strange thing called financial instruments. So really what we've done the whole time is we've basically gone through these steps as I've taken you through the general theory. And that's first of all, to determine whether we have a debt or an equity instrument. We said debt, what buzzwords are we looking for? We're looking for loan, we're looking for bond, we're looking for debenture. Those are going to be a form of debt instrument. Or an equity instrument, what buzzword are we looking for? We are looking for share capital. Okay, we then move on to our second step and we want to determine, do we have a financial asset or a financial liability? And remember, I said your perspective is going to be everything. That is what we're going to be looking at because, and this is the common one I get asked in consultations is, well, if we issue debentures or if we purchase debentures, what is the difference here? Why are the one a financial liability and one a financial asset? And that's because it's all about the different perspectives. So you have two different companies on opposing ends of a transaction. So you might have a company that issues debentures. If they're issuing debenture, it basically, say in your mind, they are writing an IOU. So they're issuing a debenture. It means they're writing out an ROU. It means they're receiving money today and they're going to pay it back in the future. If you have to pay somebody money back in the future, we know we're going to have a financial liability. On the other end of the perspective, on this spectrum, is what if we have a company that is purchasing debentures? Okay, that means they're loaning money to somebody else and they're buying an ROU note. So when you see purchasing debentures, I want you to think in your mind they're buying a piece of ROU paper. That's really what they're buying. So they're giving them money today, but they're going to get back their own money in the future. If they're going to get back their money in the future, it means they have a financial asset in their books. So as you can see, one company will be issuing the ROU, they'll be giving out the ROU, and another company will be receiving that ROU piece of paper. So in one company's books, it'll be a financial liability. And for that same transaction, in the other company's books, it will be a financial asset. And that's why I'm always stressing the fact that it's important we know, are we looking at it from the company who's issuing, or are we looking at the point of view of the company who is purchasing? Very, very important. And we then move on to our classification in terms of our measurement. For our financial asset, for debt instruments, we want to look at, are they going to be collecting? Is their intention only to collect the contractual cash flows? If that's the case, we use amortized cost. If the intention is to collect and sell, we use fair value through OCI debt. And if it is simply to sell that financial asset, we use fair value through profit or loss. Where we have a financial asset for an equity instrument, again, we're looking at the intention, whether it is held for trading or a contingent consideration as part of a business combination. But remember, this one makes it a little bit easier because they do have to make that initial recognition decision on whether they want to use fair value through OCI for an equity instrument. And that's so nice because then they have to tell us that in the question. And then finally, for a financial liability, again, we're looking at our intention ultimately driving that classification of, are we going to use amortized cost or are we going to use fair value through profit or loss? Okay, we then have our measurement methods here. But before we go through these measurement methods of what we're really going to be follow once we get to that point, I do want to share with you a diagram that I have posted for you on Learn. This really just sums up our basic 4 steps. And I'm going to run through it with you. So hopefully when you look at this, it doesn't just look like chicken scratch and it does make some sort of sense to you. But of course, we all learn differently. So I'm hoping that this is going to help some students who are maybe more visual. It's all going to be up to the way you learn and the way is best for you to actually gain and retain that information. So for me, I like to draw diagrams, particularly your little spider diagrams, to be able to see the bigger picture and to be able to take one glance at this picture and be able to actually complete a question. So with financial instruments, our first step we said is to determine, do we have a debt instrument or an equity instrument? So debt, do we see debenture or loan or bond coming up? For equity, do we see share capital coming up? We then move to step 2, which is broadly to determine, do we have a financial asset or a financial liability? We said that's going to be really, really vital in terms of perspective. What is the company doing? Which company's perspective are we looking at the transaction from? And then this like pink color is for our debt instruments for financial assets. And really, if their intention is to collect, we use amortized costs. If the intention is to collect and sell, we use fair value through OCI debt. If it is simply to sell, we use fair value through profit or loss. Then this like blue color is for our financial equity instruments for financial asset. If they're not going to be traded and there's an irrevocable designation, then we use our fair value through OCI equity. Otherwise, our default is using fair value through profit or loss. With financial liabilities, if they are held for trading, we use fair value through profit or loss. Other alternative is using amortized cost. So if they're not held for trading, we use our amortized cost method. And then step 4 is really to look at our transaction costs. All of them are capitalized except for fair value through profit or loss under financial asset and a financial liability. So fair value through profit or loss is the only ones where we expense. And I've included here our capitalization for the financial liability is fair value minus the transaction costs, which we saw when we drew up our little diagram. And so hopefully this will be something that you guys can use. You can adapt it, use it, change it up for what suits your learning style. And hopefully that will just make things a little bit more clear when it comes to financial instruments, because I know there's a lot of rules, there's a lot of things we need to consider. So hopefully this will just help you in your decision-making process when you apply to your various questions. And so like I said, that is available for you under the Financial Instruments Workshop section on Learn. Okay, we're also going to look at your basic measurement. So when we're using fair financial asset at amortized cost, what we're going to be applying is fair value at plus our transaction costs. For our effective interest table, you'll see that coming through to work out what is our interest, what is our payments, and we may need to account for any loss allowance. Our fair value through OCI debt, very similar method. The only thing is we're going to add in here looking at revaluation at year end and taking any fair value gain or loss directly to OCI. Where you have fair value through OCI equity, you see here we don't have that whole table that we need to be cognizant of. So we're not going to worry about interest and repayments and anything like that. Think about it, it's equity, it's shares. So it's a little bit simplified. We're only going to be looking at the changes in fair value at the end of each financial year. And similarly with our fair value through P&L, only thing is our starting point, we're going to be expensing our transaction costs that won't be included in the initial cost of our financial asset. And then at year end, ensuring that we revalue all of our items to fair value, taking any gain or loss to P&L. So as you can see, it's very important that we stipulate that fair value gain or loss in brackets after the accounts. We need to see, are you referring to OCI or are you referring to P&L? If you write SOCI, I don't know which section of the statement of profit or loss and other comprehensive income you're referring to. So it is important that that is shown directly in your journal entries. Our financial liabilities, so a little bit easier. We've got our financial liabilities amortized cost. Of course, that means capitalizing our transaction costs, which we said, right, that means deducting it from the fair value. And as we expect to see here with any type of debt instrument being a financial liability, we expect to see your interest payments as well as your annual payments coming through in the form of a table. Whereas fair value through P&L, we are going to be expensing our transaction costs. So our starting point is slightly different. However, we will still move through and provide for our interest table. And then at year end, going one step further, and that is assessing what that new fair value is and taking that gain or loss directly to profit or loss. And now that we've looked at all of this in detail, we are going to go through, I think I have 4 examples for you today, 3 that are really focused on financial instruments, and then a 4th one that is more on the theory side of things and is part of a past paper. Okay, so let's look at our example 1. Our scenarios on the 1st of January 20.0, Jellyfish Limited purchased 80,000, 10%, 100 Rand par value debentures in Pearl Limited. Okay, so they've purchased debentures. We're going to be very careful when we want to look at the required as to what they are referring to. Are they referring to the books of Pearl, or are they referring to the books of Jellyfish? Remember, very important. A long-time supplier of fishing equipment to Jellyfish Limited. The debentures which Jelly Limited appropriately classified on initial recognition pay interest annually in arrears on 31st of December each year at a coupon rate of 10% per annum and are redeemable at par on 31st of December 20.4. Jellyfish Limited expects to hold these debentures until redemption date in terms of their business model for investments. These debentures were purchased at their fair value of 115 Rand per debenture. The transaction costs amounting to 60,000 Rand were incurred on the acquisition of the debentures, and on the 31st of December 20.0, the fair value of the debenture was 120 Rand per debenture. Regarding the debenture investment, Jellyfish Limited has a business model whose objective is to collect the contractual cash flows from those investments, and we are to assume an effective interest rate of 5%. You are then required to draft the journal entries to record all matters relating to the debenture investment in Pearl Limited in the accounting records of Jellyfish Limited for the year ended 31st December 20.0. Okay, so they want you to record the matters in the accounting records of Jellyfish Limited. And what happened with Jellyfish Limited? Jellyfish Limited purchased 80,000 10% 100 Rand par value debentures. Okay, so we're going to go through our steps now. I'm actually going to put up a poll, and I want you to go through the steps and see if you're able to use the diagram or you're able to use the steps correctly to move through the motion and ultimately get our classification right. Okay, so I'm going to launch a poll for you now. I want you to please work through this question and answer each of these steps for me, step 1 to 4. Okay, it looks like most of you have it right. Yeah, very good. Okay, so let's have a look at it. Let's go through the steps. Some of you have already done it and you did very well. So do we have a debt or an equity instrument? What do we have here? Debentures. Debentures. Do you think that is a debt instrument or an equity instrument? Okay, debentures, it's a form of loan. It's a debt instrument. Very good. And now Jellyfish purchased debentures. So what does that mean? What has happened to Jellyfish? They've purchased debentures. It means that they've bought an ROU. Remember, they've bought a piece of paper, an ROU. Okay, so it means they've given money today, but they're going to get back money in the future. So if you're going to get back money from someone in the future, like a debtor, what do we have? A financial asset or a financial liability? Financial asset, very good, very good. Okay, so we have a financial asset here. So it can be confusing because I know some people say, well, we have a debt instrument, so we must have a financial liability. It's not the case. Remember, for Jellyfish, they have a financial asset. But for Pearl, what will Pearl have? Will Pearl have a financial asset or a financial liability? Yes, Pearl will have a financial liability. Very good. Okay, so as we can see, this required asked us to look at the accounting records of Jellyfish. Because we are looking at the accounting records of Jellyfish, we know that they've purchased the debenture, so they've bought this ROU note, means they're giving money today and they're going to get back money in the future, and so they have a financial asset. So we have a debt instrument, that's a financial asset, and then we were given this very important sentence here, where it tells us that the objective is to collect. They told us here the objective is to collect the contractual cash flows. If we look at our diagram where we have a debt instrument, financial asset, we're looking at the pink section. The intention is just to collect. We're then going to use amortized cost, and we are going to capitalize our transaction costs. How easy is that? Well done, guys. Well done. I know it's a lot to take in, but you've done very well. Okay, so we know exactly what to do now. We can actually go ahead and draft our journal entries. Well, before we get to drafting journal entries, we know that we're using amortized costs. So we want to see some sort of table coming through. And this is where we would want to start off. Okay, so we would want to start off with our effective interest rate table. We want to know how are we going to value our financial assets. Our financial asset at amortized costs, we take the fair value plus the transaction costs. Okay, so our fair value is 80,000 debentures at 115 per debenture, which means we have 9,200,000 Rand. We need to add our transaction costs of 60,000 Rand, which means we are starting off with a value of 9,260,000 Rand. I want to do this with you because I want you to be able to see how do we actually get this whole table filled in. Okay, when we're working out our interest, okay, we were given our effective interest rate in the question, and that's what we're going to use for this interest column. At 5%, we take this balance from working one. So we take our full balance of 9,260,000 and we multiply it by 5%. That then gives us our interest of 463,000 Rand. Okay, we then move on to our coupon rate, which is our bank payment. And that is going to be based on our face value. So it's 80,000 times by 100 Rand times by 10% coupon rate gives us our payment of 800,000. We take our balance and we add our interest minus our payment. It then gives us our closing balance. Okay, there is a request to explain again why we have a financial asset. So in this scenario, Jellyfish was purchasing a debenture. So it means they were giving money today and they were buying an ROU. So a little note piece of paper, it says, I owe you. So they gave money to Pearl today, and that means in future, Pearl's going to pay them back. If you have somebody who owes you money, so you're a jellyfish and somebody owes you money, they need to pay you back in the future. They owe you money today. If they owe you money, it means that it's going to be an asset in your books. Okay, I hope that clears that up. Okay, so this also provides us with a little bit of a note here that I've tried to include to really just illustrate this concept. So Jellyfish purchased the debenture, so they paid money up front, and they're owed the money. They're owed the money from Pearl. They're going to be paid it back by Pearl in the future. So Jellyfish has an asset. So they're going to receive interest, and they're also going to receive their annual payments of 800,000. Okay, so when we look at our journal entries, we're really just applying this. A question was saying, so the bank payment is always calculated on the face value. Yes, that's correct. Your payment is always using your coupon rate and your face value, whereas your initial balance is using your fair value, and your effective interest rate is based on this, whatever this balance is. Okay, very good question. Question asking how I got the 8 million. Okay, so I took the 9 million, this balance, 9,260,000, added the interest of 463,000 minus the payments of 800,000 to get my new balance. Okay. Sorry, have I got a typo? 8923. My apologies. Thank you. Thank you so much. Now, some people are asking, say, would it be more appropriate to say receipt instead of payment? Yes, you could, because of course this is an asset. I'm just using a standardized table, but yes, you could have this as a receipt if you would like instead of payment. That would be completely acceptable, because as you'll see in our next slide, it is a receipt. You are going to have a debit bank for that 800,000 and credit the investment in debentures, the financial asset for the 800,000. So 100%, you're welcome to label it receipt. There are no marks that are applicable to the headings of those tables. So absolutely, whatever you're comfortable labeling it as, you can label it as bank, you can label it as payment, you can label it as receipt, all will be acceptable. Okay, it's simply part of your workings. Our very first journal entry relates to the start of that table where we did working one and we worked out our investment in debentures. And we worked out a debit, our investment in debentures, financial assets. And as you can see here, we've got the full journal entry. We've got the dates, got our accounts, we've got our elements, and we have our narration. And also what they've included here is the working. But really, it's up to you. You shouldn't go about duplicating your workings. Of course, I've done it in your slides here for the purposes of learning. But when you get to your tests and exams and that type of thing, it really isn't necessary for you to repeat your workings again. You don't have time for that. And you're only going to get the mark once. So whether you put your working here or you put your working here, wherever it is suitable for you, and then you can simply proceed to include working one here somewhere in this journal entry as a reference. And the 60,000, I'm getting a question, where did the 60,000 come from? So that was in our question, we're told the transaction costs. And since we are using the amortized cost measurement model, we have to capitalize the transaction costs to the cost of the financial asset. So we had to add the 60,000. We then are going to record basically these two elements from our table, the interest and the payment. This is what we're going to be recording now as we move through for this financial year. So we've recorded this on the 1st of January. We're now going to record the interest and the receipt, shall I say, for this financial asset. So the interest, we debit our financial asset and we credit interest income, P&L, for the 460,000. So I've included my rounding up here. And then we are going to debit bank to show the receipt of the 800,000 and credit our investment in debentures. Okay. Another question that's coming through is asking, is it fine to show the capitalized transactions in a separate journal entry? Yes, you can. You're welcome to do debit investment in debentures with 9,200,000, credit bank with 9,200,000, and then another journal entry saying debit investment in debentures 60,000, credit bank with 60,000. You can absolutely do that. Whatever you are more comfortable with, both will be acceptable. It's essentially the same thing. And the markers are trained to look out for things like that, where students have either split journals or whether they've amalgamated journals. I mean, we could even put these journals for the interest and the payments as a single journal if you wanted to. Okay, so that's also acceptable. Okay, so quite easy. As you can see, this is the type of information you'd be given probably in a bigger question, and really you can just pull it out. So it's going to be a small part of a larger question. So you might be given, this is the transaction with Pearl Limited, and then this is what your working would be for those journal entries. And as you can see, it's only 3 journal entries, could be 4 if you want to expand it with the transaction cost separately. It could even be 2 journal entries if you want to amalgamate these 2 journal entries together. So you could do that. So as you can see, it's not going to be a huge entire question standalone on its own. It's going to be a part of a bigger question, as you've come to expect from 211. And that's really what we've done for these types of workshops, is we actually just pulled out of past papers and used them as part of our workshop. So as you can see, it's really just smaller elements of a larger question. And if you're able to just identify that, okay, this is financial instruments, and you just focus in on that information rather than get overwhelmed by the huge big question, that's just going to help you focus a bit more, and you're definitely able to tackle it. I mean, you guys have shown me that you would be able to tackle it. A question saying, would I lose marks if I just write investment SOFP and omit the indebentures? Okay, so I would prefer that you write financial asset investment, so I'm able to see that you were able to classify that as a financial asset. That's going to be the important part here. You would be able to leave out the indebentures part. That wouldn't be vital unless the question has debentures, bonds, and share capital. Then it might be a bit better for you to say investment in debentures if you've got other financial instruments. So we're able to see which one you're talking about. I hope that makes sense. So it really depends on the question, but the important part here is if you say financial asset investment, SOFP, that would be fine. We wouldn't mark you down for that. But if you do have different financial instruments within a single question, then it might be important to include debentures or share capital or bonds, so that we're able to see which one you're referring to and mark you and give you part marks accordingly in case that's necessary. Okay, good questions coming through, guys. I'm impressed. Shall we move on to example 2? Yeah, I think we're all good on the question side. So we'll move on to example 2, and then we will work through those 4 steps. I will launch a poll. So let me just read the scenario to you. It's on the 1st of January 20.0, Crab Limited, who has a 31st December year end, issued 2,015,000 Rand 0% debentures at 10 Rand each. The debentures are compulsory redeemable on 31st December 20.8 at 25 Rand each, and they are traded on the JSE. On the 31st of December 20.0, the debentures traded at 18 Rand each, and on initial recognition, Crab Limited classified the debentures as at fair value through profit or loss. Isn't that nice when they give it to us in the question? They then ask us to assume an effective interest rate of 10%. You're required to compute the amount at which CRAB Limited would present items relating to the debentures in the statement of profit or loss and other comprehensive income for the year ended 31st December 20.0 and in the statement of financial position at 31st December 20.0. So this is quite nice because we're not focusing on journal entries here. We're actually looking rather at the disclosure and presentation side of things. So I'm going to give you a few minutes to work through our steps and answer on our poll. And that will just help to see that we are on the same page. Okay, you should see the poll on your screen now. If you would be so kind as to tell me what type of instruments we have, the classification, the measurement we shouldn't be getting wrong. It was given to us in the question. And then how we're going to account for those transaction costs. Okay, brilliant. It looks like most of you have got the correct answer. Okay, so firstly, debt or equity instrument. We are dealing here with debentures again. So nice, easy one. We have a debt instrument. Okay, debentures being a form of loan, being a debt instrument. Then classifying our instrument, do we have financial asset or financial liability? Very good. Here we have a financial liability. So it's nice to see how this was different to example 1. Okay, because here they issued the debentures. Example 1, they purchased the debentures. So we had a financial asset. Here they are the ones that issued the debentures. That means, what do we think of in our brains when we see this wording of issuing debentures? We think to ourselves, they have written out an IOU note. So that means they got money today and they have to pay back the money. Okay, so hashtag pay back the money. Let's tell them they owe money. So they have issued the debentures, they owe money, they're going to pay back in the future. That must mean they have a financial liability if they owe somebody money. Okay, we then said, nice, easy one. They told us in the question, fair value through profit or loss. What they also did as a nice little hint here was that they said it is traded on the JSE. Okay. So that was just a little helpful hint in terms of our classification. If we look at our PDF here, if they were silent and we had a financial liability and they didn't tell us that it was fair value through profit or loss, we saw that it's traded on the JSE, so it's held for trading, therefore fair value through profit or loss. So they actually didn't need to be so kind and tell us the measurement. We could have worked that out ourselves and said, well, they gave us that information and said it's held for trading on the JSE, therefore we have fair value through profit or loss. Okay. We then said, because we have fair value through profit or loss, it's the nice one in terms of our transaction costs, we are simply going to expense them. So when we look at our workings, we need to start off with our financial liability at fair value through profit or loss. We simply take our fair value. So it's the 2 million debentures at 10 Rand each. So we have a starting point of 20 million as our opening balance and our initial recognition. Yes, this is a debt instrument. I'm just getting some questions in the chat. This is a debt instrument because it is a debenture. So as you can see, we had a debenture in example 1 that was a financial asset. And here we have a debt instrument, a debenture again, but it's a financial liability. Okay, so be mindful of that. Don't make this assumption that because it's a debt instrument, it's automatically financial liability. Okay, we then work out our effective interest. So we take our balance, which was 20 million per our little table there. We times it by our effective interest rate of 10%, and we get our interest of 2 million. Nice and easy. And then our payment, remember our coupon rate was actually 0% in this question. So you have, just for the purposes of completeness, our payments will be 0 Rand annually. You wouldn't have to put this in, but I'm putting it in because I think it just makes it complete and I don't want anyone to get confused. So you'll see here, this explanation is actually the opposite that we had on our previous example, where here we issued the debentures, which means we received money today. We received money up front and we owe it. We have to pay back the money. So we have a liability because we have to pay back that money, and we will be paying interest and the annual payments, but in this case, it's at 0%. Yes, we have a question. Ntobeko, do you want to ask? Oh, hand is gone. Yes.
I'm not sure. Okay. Can you please move back to slide 17? Like there's a slight confusion that I personally have.
Yeah.
Is that I'm seeing a lot of rands each. Like I see 15 rands, 10 rands, and also 20 rands. So like it's very confusing to me what actually goes on with those rands. How do you identify the coupon one? How do you identify for us to calculate the balance, the closing balance per se? How do we identify? Because I'm very confused on that part.
Okay, so let me go through that with you. I'm also getting some direct messages as well asking about 10 Rand versus 15 Rand. Okay, very good question. Okay, so the fair value is basically the amount that you're going to pay for those debentures. So these are 15 Rand debentures in terms of their face value, but they're only paying 10 Rand each. So that means our fair value is 10 Rand each. And when we recognize our financial liability in our books, we have to use fair value. Okay, so we're using fair value at 10 Rand. That's because that's what we physically paid for this financial liability. Okay, does that make sense? The coupon rate will be based on the face value, and that is what you are given here. They're saying they're worth 15 Rand each in terms of their face value, but we only paid 10 Rand each. So 10 Rand each being our fair value used for our initial recognition in our books. The 10 Rand each and the 15 Rand each being used to work out our payments. Okay, so our payments that would be done on an annual basis, which in this case was at 0%, so there's 0 payments. Then the debentures are compulsory redeemable at 25 Rand each in 8 years' time. Okay, so at the end of December 20.8. So that's not something we need to worry about now because that's not going to affect this financial year. But what we are interested in is the fair value at this year end, which is 18 Rand each, because we're using fair value through profit or loss. Okay. So when we look at our initial recognition journal entry, we said we're using the fair value, which is what was paid for those debentures, which was 10 Rand each. Debit bank, credit our financial liability, because remember, we were the ones who in fact issued the debentures. So we're receiving money today and we owe money in the future. If we are owing money, what type of interest do we expect to see coming through? Well, it's going to be our interest expense. So debit our interest expense of 2 million. It's based on what this liability was raised at of 20 million at 10% effective interest rates, and that we're going to add to our liability. Then we're at year end. We want to update what is the financial liability in our books. Well, it's sitting at 22 million Rand. But what is the fair value of these debentures at year end? We said at this year end, December 20.0, the debentures are traded at 18 Rand each. That must mean that our debentures, our 2 million debentures, are actually valued at 36 million Rand at year end. Now, because we have to measure using fair value through profit or loss, we need to provide for an adjustment in our books. So we need to adjust in our books. Our financial liability is sitting at 22 million Rand, and we need to update it to the fair value of 36 million Rand. And how are we going to do that? We need to increase our financial liability from 22 to 36, which means we need to increase it by 14 million Rand. And to increase our liability by 14 million, we have to, of course, credit our liability, and then we debit our contra account being fair value loss, P&L, very important. I need to know, are you referring to P&L or are you referring to OCR? Okay, we're using fair value through profit or loss, so we must put their P&L, and that is our 14 million. So you weren't required in this question to provide the journals, but I did it for clarity purposes, so we're able to see the full mechanics of this journal, of this transaction, shall I say. When we move through to our actual disclosure, this is what we should expect to see coming through. We expect to see in our statement of profit or loss and other comprehensive income a fair value loss of 14 million, as well as the finance cost, the interest expense of 2 million. When we move through to our statement of financial position, what do we expect to see through? Well, our bank is sitting at 20 million. That's what we received. And we have our financial liability at the fair value, the updated value of 36 million Rand. And so this is just an extract for you. Of course, as we said, this would be included in a larger question. So really, this is just for the purposes of pulling out the financial instrument elements. Okay, so we move on to example 3. This is our last complicated example. Your fourth example is really basic, and it's just looking at the theory side of things, which I'm not sure if we'll have enough time for today. We've got 20 minutes left. We'll see how far we get. But we'll go through example 3, which is more on the mechanical side of things. When we look at the scenario, we're given the 1st of January 20.0, Shell Limited acquires a 5-year bond with a contractual value of 15,000 Rand at its fair value of 10,000 Rand. So here we can see again, we're given 2 different values. This fair value of 10,000 Rand is what we expect to see at the initial balance of our table. 15,000 is the contractual value. So that's what we're going to be using. This is our face value. So this is what we're using for our payment section. The bond carries fixed interest at 5% paid on 31st December annually. In terms of its business model, Shell Limited classified the bond as a financial asset at fair value through OCR. So again, these kind people have told us the measurement, so we didn't even have to work it out. They told us that they have used financial asset at fair value through OCR. Fair value of the bond was 10,500 and 11,000 Rand on 31st December 20.0 and 20.1 respectively. We're then to assume an effective interest rate of 10%, and we are required to draft all entries in journal form relating to the bond investment in the accounting records of Shell Limited. So like I said, very important whose perspective we are doing this from. We're doing it in the accounting records of Shell Limited for the years ended 31st December 20.0 and 20.1. Okay, so we're not going to launch the poll for this one because they really gave us a lot of the information already in the question. They took out a lot of the guesswork. Let's just say to ourselves first, this bond, because we haven't done a bond before. Is the bond going to be a debt instrument or an equity instrument? Okay, it's a debt instrument. Very good. Very good. Okay, so it's a debt instrument, and then they are acquiring a bond. Okay, so that means that they are going to be paying now upfront, and they're going to be paid back in the future. So do they have a financial asset or a financial liability? Financial asset. Very good. Very, very good. Okay, so we've got a debt instrument for a financial asset, which nicely they gave us to it in the question. They told us it was a financial asset. And we know we're going to use fair value through OCR for debt instruments. Okay. If we're using fair value through OCR for debt instruments, what are we going to do if we had transaction costs? We don't have in this case, but if we had transaction costs, would we expense them or capitalize them? Capitalize them. Very, very good. Well done. Okay, so we're going to move on to our workings. It is a debt instrument, so we do expect to see a table coming through to work out our interest and payments, or in this case, shall we say receipts. Okay, so we start off with our fair value, and that is what is going to be paid for the actual bond. Okay, so in this case, it was 10,000. They gave it to us in the question that they're paying 10,000 for the bond itself. And we then work with our interest. You're working with our interest. Our effective interest rates is what is important. So we start off with our balance that we were given. We've got that and we've put it in our table. We use that balance. We multiply by our interest rates to get our interest for our table. We then work out our payments. And remember, that's going to be on the face value. So is that going to be 15,000 or 10,000? What am I going to use here to work out the payments? 15,000. Very good. Yes, very good. You guys have got it. Okay, so 15,000 times by our 5% coupon rate that we're given in the question. So the payment's going to be $750. Whoopsie. Okay, so we update our balance. We take the 10,000 plus 1,000 minus the 750. Hopefully I don't have a typo today. 10,250 should be our updated balance for the end of 20.0. We then need to work out our interest. It's going to change because our balance has changed from 10,000 to 10,250. So we take our updated balance of 10,250. We times it by our effective interest rate to get our interest for the second year. Our payments are staying the same. Nothing changes there. We still got the same face value. Your face value doesn't change, and our coupon rate doesn't change either. We can then update our balance, 10,525. Okay, some students are asking why it's a financial asset. Okay, so they're acquiring the bond with the contractual value. Okay, what they're saying here is they are buying the bond. So if they're buying something, they're paying for it today, and they are going to be getting that money back in the future. Your question also gave you the information that it was a financial asset. So you didn't have to guess on that front. It was given to you in the question as well. Okay, they will be specific to you though. Acquiring, I guess, could be a bit of a ambiguous term. Perhaps they could say that they were the ones who are actually providing this loan to somebody else. So they're giving the money today and they're going to be getting back the money in the future. So perhaps that was slightly poorly worded from another textbook, but that is the way they had included it. But really what we're looking at is someone who Shell Limited is basically the one giving out or providing a bond to another company. So they're giving the money up front and they're going to be paid that money back in the future. Okay, so that's how they have taken it as being. Okay, so we included here that they purchased it. So basically they paid money up front and they owe the money in return, having an asset. And so the interest that we receive on this asset is going to form part of interest income, and any payments received are going to be a debit bank, or rather a receipt, as we saw with our previous financial asset question. Okay. We have a query saying the different numbers for the workings within the table are a bit confusing. Normally I see the whole effective interest rate table reference as just working one, reference to all amounts. Okay, so in this question, we had a case where we've done 2 years. Okay, so your interest is going to change based on what your updated balance is. So you can't say your interest for the second year is going to be 1,000 Rand as well. It's not the case, because your interest is going to be based on this balance, which is changing, as you can see, as it goes through each year. Okay, so that's why I've got an additional working 3 here. For the payment, because it's consistent throughout, you could simply put working 2 there if that made things a little bit easier for you. But your interest is going to change based on what this ultimate closing balance is. Okay, and that is why we have different workings here, because it's not going to be 1,000 Rand standard interest for every single year. Even if we did 30th of December 20.2, that interest would in fact be 10,525 times 10%. So your interest would be 1,053 for the third financial year. Okay, so your interest is going to change on an annual basis because this closing balance changes as it goes through the number of years. Okay. What's important is we're going to be looking at the adjustment in our books, especially because this is using fair value through OCR for a debt instrument. And the balance as per our books at the end of December 20.0, we look in our table, end of December 20.0, our balances 10,250. Okay, so our balance is 10,250, but we were told at year end the fair value was actually 10,500. So as we can see, we need to update this to the correct fair value through OCR. So we need to adjust from 10,250 to the fair value of 10,500, which means we must increase our financial asset by 250. By debiting our financial asset with 250 and credit our fair value gain, OCR, very important that we stipulate that, not P&L, not SOCR, it must be OCR, and that's with the 250 fair gain. When we move forward to the 30th of December 20.0, remember our books were adjusted. Okay, so we had an adjustment in our books. We look at all of our journals. There are my journals here. Okay, so we've done our initial journal of 10,000. Okay. We then accounted for in a single journal here. They've done the interest income of 1,000. The bank of 750, and then they're saying the net amount of 250 to the financial asset. We then also had a fair value adjustment to our financial asset of 250. And we then start off with the 31st of December 20.0. We need to account for the interest and the payment for that. So we get that from here. these two amounts we want to journalize. So our interest income of 1025 and our bank of 750. So here's our interest of 1025 and our bank of 750. The remainder going directly to our financial assets of 275. So if we want to determine what is the updated balance of this financial asset in our books, remember at the end of 20.0, we updated it to 10,500. And now we've just processed a journal for 275 to increase the value of the financial asset. So we updated it to 10,500 at the end of 20.1. We then added an additional 275 being our December 20.1 adjustment for the receipt as well as for the interest income. That means in our books, our financial asset is sitting at a value of 10,775. But when we look in our question, it tells us that the fair value is now at a value of 11,000 Rand. And so we need to move from 10,775 to 11,000 Rand. And that then means we have another gain. So to increase our financial asset value from 10,775 to 11,000 Rand, we need to increase our financial asset by a value of 225 Rand. How are we going to increase an asset? We must debit our financial asset SOFP with 225 Rand and credit our fair value gain OCR with 225 Rand. Okay, students asking, how did we get 275? Okay, so this was basically from our journal entry. We know we had to credit our interest income of 1,025 and debit bank with 750. These figures were given here directly from our table when we worked out our interest and our receipt for 20.1. And that then means that a total of 275 would increase our financial asset to balance our journal entry out. What you could also do is you could debit bank 750, credit financial asset 750, and then debit your financial asset with 1025 and credit interest income with 1025, but you'd end up with the same net amount of an increase in your financial asset of 275. I hope that clears that up. What I wanted to do as a bit of a devil's advocate, because we had so we first have to recalculate the closing balance. Yes, we do have to recalculate our closing balance. Remember, we had updated it to 10,500, and then we would need to adjust for our fair value after taking into account our interest and our receipt. So if you take the 10,000, add 250, we were sitting at 10,500. Then we processed a journal for another 275. Then we were sitting at a value of 10,775. And our fair value was 11,000. Okay, so you do have to do all your journal entries, and only right at the end would you look and want to determine, do we have a change in our fair value? And then to be devil's advocate, because in both these cases we had an increase in fair value, so we had a fair value gain. I wanted to change the question a little bit and said, well, what if our fair value wasn't 11,000 at the end of the second year? What if it was 10,000? So it actually went down in value. So if it went down in value, you would have a decrease in your financial assets. How do we decrease our asset? We would credit it with 775,000 and we would debit fair value loss OCR, 775 Rand. So that was just a little bit of an adaptation to this question to see how would things change if we had a scenario where the fair value at the end of the second year was actually lower, because as you saw in both these questions, you had a scenario where it had increased. Okay, we've got a real few minutes left. So let's have a look. This is actually a past exam question, so we're not going to go into it in a super amount of detail. But as you can see here, you were given a discussion type question, and they really focused on the basics of shares. So this is quite a bit of first year work that you are already familiar with. I just want to highlight a couple of points to you. They used a memorandum type format. So as you can see, easy marks, therefore a format and a basic introduction. They then looked at the liability definition as well as that of an expense. They then focused on the elements of the settlement of the obligation, because there was a compulsory redemption here, which was a form of cash of 750,000, and they actually split it up into the nominal price of the shares that they're repaying, the premium of 50,000, as well as the annual dividends, which was 50,000 for 4 years, being 200,000. So you can see there was quite a bit of mechanics here included in their application of the theory. You don't want to end up in a scenario where you are just providing us with basic theory and not actually applying it to the question. Where some students battled in this question was in terms of the recognition criteria. So relevance, you want to look at two types of uncertainties. The outcome of uncertainty, I mean, if these shares are compulsory redeemable, there's no uncertainty in terms of what's going to happen. They are going to be redeemed at that certain date. So there's no outcome uncertainty when you have these compulsory redeemable shares. It's already committed. It's already part of the agreement of the sale of those shares in the first place. So there's no uncertainty there. And the existence uncertainty, there's no existence uncertainty, because again, we have a scenario where there's agreement between the entity and the shareholders. The shares exist, the transaction exists, and there will be source documents in the form of a share certificate to prove as such. There's no measurement uncertainty as well, because you're given the value in the question, 2 million Rand, include that in your solution, and it just provides some application. They're 2 Rand each. So the cost is reliably determinable. There's no issues in terms of that uncertainty. They then go into, again, our basic conceptual framework. And this you have already established from first year, hopefully. You've got a good foothold on this. And this really is just showing you how you can apply your conceptual framework to a section such as financial instruments. So it's not something that we should be leaving out in any degree. It is going to be important as you see you coming through in your tutorials as well. And then your final sign off. Okay, and as with all our theory questions, 17 marks available, and you only need a maximum of 12 marks. So there is often more marks available in your discussion questions than what you need to achieve. I think that's where we're going to leave it off today. I don't want to encroach on the next lecturer's time starting at 10:30. Please, if you do have any questions, do let me know, and I'll be happy to address them for you. Thank you so much for joining us today.